Individuals that own businesses have opportunities to do things individuals who don't own businesses can't necessarily take advantage of.
We're going to be talking about understanding your business and finances and how they integrate. So what does this mean? This is not talking about how do my P&Ls work and the balance sheets and, where does revenue come from? That's what you do as a business owner. We're not here to teach you anything about that. This is talking about the integration between the business, which is an asset, the same way that a house or a car or a 401k are an asset for you, integrates into your personal financial planning. So how do we use it as an asset in your personal plan? What comes from there is a couple of issues. One, most owners separate those two things. They say the business is its own financial engine that does certain things, and I worry about the taxes and the impacts and the income there. Then I have my personal plan. The income comes from the business, and we work on everything else coming off on this end. The reality is, if you have a 401k as part of your asset base on your plan, the business is there too. Just happens that a business is infinitely, in some ways, more valuable in terms of resources and options it has to impact what your financial plan looks like, tax avenues, revenue sources, and different ways you treat it. So when you're making decisions for your business, those decisions need to kind of run through a lens that needs to be clearly articulated with values driving the decision process. And it starts in this order. Number one, why are you doing this in the business for yourself? There's a reason why you started this business, and it may vary for everyone, but they generally fall in a few different areas and criteria. But anything you're doing in the business, an investment, a profit share coming out, an expense or liability you're taking on, how is this helping you achieve that goal or vision that you had? Number two, how is this affecting your family? Are you adding risk onto the business or the continuation or succession, which we'll talk about later, that could make the value of your business harder for them to attain or reach, or push something to them that you don't want to? Or does it add significant value to your family that is worth it and you really want to make that decision? And then number three is going to be your employees and the business itself, which most owners think about as a child. They look at their business and work in the same part of their brain through studies we've reviewed that show that entrepreneurs see their business as a child. So we have to keep the context and values in that order for making those financial decisions and how they may impact your personal plan. Throughout that process, working with a cohesive reason for how we're using the different resources a business has to maximize income and revenue, pull value out into your personal planning so that less and less of the actual value of the business matters for how you successfully become financially independent of that and are able to retire. One of the ways that we're able to understand that connection and be able to make solid, quick, and effective decisions with your business and your personal finances is to understand your number. Now, what does that mean? Understanding your number means having a plan and understanding what you're trying to achieve, what are the timelines to achieve that, what are the milestones, what is a non-starter and what is a requirement in that plan that will bring you to your goals, your values-driven goals. From that, we can build an actual financial number that would mean you have attained that goal or outcome. Now, the only way we can get there is if you have a written, reviewable, personal financial plan. If you don't have a written plan, then that is a part of your resource team. I'm sure as everyone listening to this video running a business has multiple different advisors and resources. And if you don't have someone who's developing and overseeing your personal financial plan, that is critical to being able to understand the connection of the business to your finances. So if there's one takeaway, I would find that right fit. But basically the whole process is having your goals, personal goals outlined, understanding where the business fits into those and how it can enhance those, and what not to do when it detracts you away from that outcome goal. There's a lot of intricacy we can get into for how those specific components may work, such as, tax advantage is a huge one we often talk about, and how to kind of drive different revenues and profits and expenses through the business or the personal side. But I think really we're going to get the most value out of having a conversation around the reality and what we've talked to with clients is some situations we've managed in the past. When we're working on a number for a business owner, when we're trying to figure out how much do you need from this business sale, and really primarily the question on the number is how much income do you need to live off of for the rest of your life? And we can work backwards into how much needs to be in accounts and different resources. Where there's often a pretty glaring miss, and I'll give you an example. There's a glaring miss in how much money they're actually using for their lifestyle. We had a client come in and wanted to sell his business, and we asked what sort of income need they had going forward into retirement and beyond, and if that income was going to change. Are they doing more, doing less? And they kind of stated, they're very happy with their life, and what they're spending now is exactly what it'll be with inflation adjustments going on forever. And we asked what that number was. It's about $60,000 a year, which was remarkable. I mean, frankly, I was shocked that, I knew generally the lifestyle they had, and was like, they're doing very frugal in how they're managing this, their income and expenses. So that was a great, easy spot to go. And when we knew the value, we go, this should be no problem. We'll be able to make this work out at the end of the day. When we got into the numbers, we pulled the business financials, the P&Ls, the balance sheets, and started looking at the tax returns. We determined that this gentleman was spending about another $80,000 to $100,000 a year on personal expenses that were routing through the business. And frankly, good strategy, right? Very good strategy for different reasons. But you can't forget about those, because if you don't have the business anymore, if you want to maintain your lifestyle, you got to replace that too. So that $60,000 a year became $140,000, $150,000 a year. It's a very different planning scenario to get to. There are ways to get to that point, but just that is, it's often missed for how much you really, the car you have, the cell phone, the meals, the travel, the different components that the business just pays for 30 years. So you never had on your balance sheet.
That's a great point. If you have what they call, I think, add backs, things that you're taking out of the business, maybe, you justifying it as a business use, like a vehicle, but you got to provide your own vehicle, right? So it's interesting. If I were taking $100,000 out, what I need, if I put it back in as an add back, I can sell the business for more. But I hadn't thought about that as clearly as you just said it. That is, I would actually need $2.5 million net in the bank or in an investment account at a 4% return to replace that $100,000 income I'm taking every year.
Right.
And if I want to use a 5% return, I need $2 million net in the bank. So in that valuation, that's a big deal.
Right. $100,000 missed is, $2 million of proceeds.
Yeah.
We got to net out.
Wow.
So
wow.
It's important to know that as far in advance as we can, getting to the solution.
If you're not 100 short, you're $2 million short.
Right.
The value of a business is an interesting one, because I know it's almost more of an art than a science, because there's some variability and different things to consider. What do you find out with all the business owners you're working with when it comes down to the value of their business? What have you picked up from them?
What consistently seems to be what we find is that the value that an owner assumes their business is worth before they've had a valuation done is, in almost every case I can think of, significantly overvalued in their mind, from the sweat equity, from the potential of the company, because they believe in what can happen. They know what can happen. They know what it took to get to that point. And a buyer coming in is looking at, what's the return I can get? And how can I create efficiencies in this business to get a higher net profit? It's not the same calculation. So when they get the valuation number of what a buyer would likely be willing to pay, it's generally lower. The other side to that too is, even when an offer comes, the understanding of that is the gross amount coming, hopefully a majority up front. A lot of times there's some, stretch payments and earn outs and other components that are over time. But that gross number is not what you're taking home. So if your business is selling for $4 million, well, we need to look through your liabilities, because if this is an asset sale, then those have to be off the book. So let's pay those off with cash received, drop by $1 million or so. Then the sale proceeds are still the sale proceeds. So we're going to get taxed. Now, if it's an asset sale, red income tax levels, not capital gains. So that's a missed component often, where most buyers want to buy you as an asset sale. not stock sale. They don't want to take on the liability and other concerns. And if you don't realize that in the transaction, it's a significant tax change from what could be a 25%, let's say, tax burden to 30, 40, 50% burden on the hit. So understanding there, not only what is it actually worth, and then now that I know what it's worth, what will I actually take home?
So what you're saying is, I think it's worth this as an owner. Then I find out now it's really just worth this, but then that's not my number after taxes and expenses. It's really worth this. So it could be half or a third of the income I'm used to living on if I'm not really looking at the numbers.
Right. And I think that is an important point to understand. With a third-party sale, it's most often, especially with a strategic buyer or somebody who's really coming in to take what you've done and maybe add it to their business or their model, that's going to generally be the highest, especially upfront price tag you're going to find for your business. Venture capital can certainly look very good on these deals. There's a little bit of caution on the backside of those often for your involvement and earnouts later. That is usually the highest number. But if you look at the whole picture and the whole package, if built well and designed well, a key person and potentially even a family transition can be quite significantly valuable to you. It's just not going to be the upfront dollars in most cases. But if you look at a 5, 10, 15-year stretch payment with some additional maybe loans coming in on top of that, that stretch by lowering the individual year tax burden and kind of tracking a continuum increasing value by incentivizing new owners to buy in different situations, the net overall gross value received can be significantly higher by having a deal done in that way.
In advance. It's important, interesting you say that. One of the things I've learned is this, no matter when you're going to sell your business, if you understand the numbers, the value, what is your business worth and what do I need when I'm ready to retire? Most business owners will and should accumulate outside the business value. So when they get to these points, the business is only a fraction, certainly not the majority of their retirement income. We'll talk about that later, I think. But yeah, good point.
Yeah. The one thing here too is why choose an LLC, an S Corp, or a C Corp. C Corps have their downsides, but there's also some upsides like a 21% corporate tax rate. There's also the potential of utilizing Section 1202 for a small business, which 50% of capital gains are not taxed at the sale. Now, there's other requirements and stipulations to make sure that you qualify for these pieces. There's also the negatives of double taxation and other components. But the reason for choosing an entity shouldn't be as simple as I'm an LLC and then I become an S because revenues went up. It should be a question of what am I trying to do? What am I trying to achieve and get to in what time period? And if a sale is the goal, a C Corp could make a lot of sense.
So what do you do in that situation, Robbie? You're talking to a client and you think there may be some opportunity if they were a different form or if they even had a second business added, right, to the business they already own. Who do you work with from there to make that decision with an owner?
When we see that there is an opportunity to look at the potential of a multi-entity structure and work through the basics of that with a client and get their agreement on this is a strategy you want to pursue, the next step would be to work with their accountant to look at does this work from the accounting perspective, right? And to get their feedback. And often there may be some specific components that need to be considered or adjusted in here to maybe tweak the plan or design. And then, of course, speaking with the attorney that they work with to make sure that there's nothing on their end they see issues with and getting the right structure set up. But it becomes a team process on where that we get to. And we have to have that involvement of the CPA to sign off on the tax returns and the structures we're doing in those cases. If you're looking for more educational content to expand on this a little further, we have a Business U workshop, which is a longer format workshop here over a 2-day period that allows you the opportunity to sit down with other business owners in the room, to ask specific questions to your needs and to dig into these topics all the way through the nuts and bolts for everything that may be of concern to you or that you need to know specifically. If you'd like to attend a workshop, there's some information below. Finally, we've been working with business owners in this capacity for almost the last 40 years. And if you're looking for that advocate, that partner to be with you as you're guiding your business, we'd love to have you be a part of the team. And we'd love to see you be that person who brings their business to the ultimate value as their most valuable asset. Thank you.